This is the Future of Finance. Hi, everyone. Welcome to the Future of Finance. I'm George Dyer, and today we have Ellen Quigley on the show. Ellen is a principal research associate at the University of Cambridge in the UK, and also special advisor to the CFO on responsible investment there at Cambridge. She talks about what she does in both of these roles in our conversation and how she works to support the endowments at the 31 colleges that make up the University of Cambridge, as well as the central endowment there. On the research side, Ellen's research on sustainability and investing is really important and really compelling. A lot of it focuses on how investors should be thinking holistically about the whole system and not just focused on individual companies when it comes to these issues. And she's just very clear-eyed about the scale of the risks associated with climate change and other sustainability challenges, both for society and investors specifically. She also talks about a new corporate bond index developed at Cambridge that will be the first to span the entire fossil fuel value chain, including producers, utilities, financing, and the first to fuse debt denial and engagement strategies in a systemic way. So if that doesn't make sense, hopefully it will after you listen to the episode. So I hope you enjoy it. As always, please follow and share and let us know what you think. And now here's Ellen. Ellen, welcome to the podcast. Thanks so much for being here. It's great to see you.
Pleasure. Thanks so much for having me here.
Yeah, I'm excited to talk a little bit more about your work and share your work. But how are things over in Cambridge today?
Gray as is somewhat usual.
I was gonna say
So
that sounds fitting. That's sort of. I still think I've only been there once, and it was with you. You were kind enough to give me a tour around campus, and I think there was an event around students calling for fossil fuel divestment. But it's just such a gorgeous place. I just love. I mean, I love England and all the old architecture, but especially that campus and all the beautiful buildings. So I'm envious that you get to spend so much time there.
it is pretty lovely. Yeah, can't complain.
Nice. Well, tell us a little bit about your work there, both because you have a unique role kind of as an academic, but also advising the endowment to some extent and, really engaging with the larger sustainable investing field. So maybe just give our listeners a little bit of an overview of what you do.
Thank you. Yeah, so half time I am an academic and I have my own little research center and we do work in this area, but I also get to test it in the real world by working as a practitioner 50% of the time, or supposedly 50% of the time,
Hmm.
advising the chief financial officer of the university on responsible investment. And that has been quite interesting because Cambridge is actually an enormous assemblage of endowments.
Hmm.
So I mainly work with the 31 bursars of the 31 colleges and their endowments, as well as some of the trusts and so on, and Cambridge University Press and Assessment and so on. I do help the central endowment a bit, but I work more with the central treasury function and the 31 colleges and so on and so forth, kind of working collectively with them on engagements with asset managers and banks and so on and so forth. So that's and there's a lot of cross fertilization between those two things, which is wonderful.
Yeah, that's great. And just for our listeners, tell us a little bit more about how that works. So you mentioned there's 30, 32, did you say, colleges at Cambridge?
Yeah, 31
31.
colleges.
And each has their own endowment, right? Or most of them do?
Yes. So 31 colleges, each one has its own endowment. The size varies dramatically. So the poorer colleges have quite modest endowments, and then Trinity has as much as all of the others combined.
Hmm.
So it's a real array. But the bursars of the colleges are almost 2-1, very supportive of this kind of work, and it's allowed us to do some really interesting things. So we do direct engagements with banks and asset managers, collective engagements, and we have those. Sometimes we have meetings with 40 people in Cambridge, chaired by the CFO,
Wow.
with heads of house and bursars and heads of trusts on our side, and then 11 people on the bank side, and so on and so forth. And we have a conversation beforehand on the Cambridge side to kind of coordinate what we're going to say. We always prioritize a very small number of asks that are research based and high impact. So we end up focusing a lot on avoiding the financing of companies that are engaging in fossil fuel expansion, actually, especially on the fossil fuel infrastructure side of things. So
Hmm.
power sector, power plants new gas-fired power plants, for example, that potentially lock in decades worth of emissions. So that's the kind of focus that we have when we go in and talk to the representatives from the banks. And then with asset managers, we really focus a lot on voting against the reelection of directors of those same fossil fuel expansionist companies. So really focusing on not just the fossil fuel sector, but the utilities sector, where a lot of this new infrastructure is being built, and then the banks and insurers that are facilitating and financing fossil fuel expansionist companies. So we really try to get the asset managers to focus on that relatively small number of companies that have disproportionate impact on the system as a whole.
That's great. And it's so cool to bring in sort of the research informed perspective because that's such a cool, unique thing about college endowments, university endowments, as asset owners, is they do have access to this whole sort of suite of research and people like you really diving into this stuff. How
As
have
you
and
know, yes.
yeah. And how are the managers? Have they been generally receptive? I mean, I feel like the industry and the whole conversation around ESG and sustainable investing is a little different over in the UK, in Europe, and in many ways kind of further ahead, I think, than here in the US. So I know these topics are, I think most managers are pretty well versed in them. Is that right? And yeah, how do they respond to that kind of engagement typically?
I still get asset managers mainly focusing on shareholder resolutions, and I've reviewed dozens, maybe over 100 papers on this, and shareholder resolutions are just not associated with anything significant in terms of company level behavior change.
Mhm.
And that's what asset managers, even the ones who are more advanced, tend to lead with, which is why we have to kind of redirect them to focusing
Towards
on director votes. Yeah.
Right. And the director votes, just for folks who aren't familiar, that's the owners of shares in these companies vote to elect or re-elect the board of directors, and that's what really gets the attention a lot of times of the board of directors if investors are voting against them, and they'll then look at why and hopefully change their behavior accordingly, right?
Well, and maybe just to dig into this a little bit more, and no need to keep this in, but just to say that the reason that that appears to be more effective is that you are targeting high status people who are individually defensive of their reputations, and
Mm,
actually even incompetent directors pretty much automatically get over 90% of the vote. So if you can get below 90% of directors or of shareholders voting in favor of those directors, they really pay attention. Even if there's no one running against them, there's no chance they can lose their seat. And it
interesting.
can make them less attractive to other boards that they might sit on. So it's actually a potential financial hit to them personally.
Mm. Yeah, interesting. Yeah, I mean, it's always fascinating. We talk about these institutions and companies and everything, but at the heart of it, they're people making decisions and having real personal sort of reactions to these concepts and stuff. So that's cool. Well, let's jump back to your academic work a bit, and specifically, I actually remember that day I was at Cambridge. I was sitting in a pub, I think, waiting between meetings, and first dove into your paper, which is called Universal Ownership in the Anthropocene, and I just got such a kick out of that title, as I've told you. For me, I just feel like it wraps up so many big concepts into such a concise title, but I am also aware that for most people, most normal people in the world, they probably don't know what any of those words mean. So let's start there as we dive into some of this work, because I know you've done a lot of work on this, and I find it just like fascinating. But maybe start by just defining for folks what universal ownership is and what the Anthropocene is, and then we can talk about how it all fits together.
Love it. These are my favorite topics. So so first, universal ownership is the idea that if you are a diversified owner of capital, you own a bit of the entire financial markets, which are fairly reflective of the real economy and certainly related in terms of downside risk. Like when things are going badly in the real economy, they tend to go badly in the financial system. And if you're a long-term owner of capital, you have to worry about the long-term performance of the market and the real economy as a whole. And that means that actually your returns are more driven by overall market movements than anything you are doing. So your security selection has a much smaller bearing on how you're going to perform in absolute terms over the long term than the overall market movement. So it's you basically have to attend to externalities that hurt the whole system, much more so than it's worth your time to stock pick and try to avoid those risks to your portfolio.
Yeah, just to put a finer point on it for people, like the universal ownership, those words refer to investors will talk about the whole universe of investment opportunities out there. And this is sort of referring to as for these big asset owners, they have lots of money in some way, shape, or form. They own basically every company in the universe, more or less. And so as you say, that then means they're not really deciding, oh, should I buy IBM stock or Apple stock? It's just they sort of own all of it. And so if the economy is going up or down, they'll have their value of their investments going up or down. And then to your point about externalities, so if one company is sort of doing well by pushing their costs off into the rest of the economy, the other companies that they're invested in may well be being hurt by that. And so as an investor, it doesn't really help them to have one company kind of game the system in a way. Is that a fair way to put it?
Absolutely. I'm just going to build on that very slightly because I think it's actually something that people might not recognize is the implication of this, which is if you own a little bit of everything, and let's say one of those companies is imposing costs on the whole system, you would rather that company make less money.
Mm-hmm.
As a universal owner, don't want all of your companies to profit maximize if it's basically being subtracted from the performance of everything else you own. So, you're probably not wanting Exxon to profit maximize if you are a universal owner.
Right, because in doing so, they'll be accelerating climate change, and the impacts of that could really hurt a lot of your other investments in your portfolio because you own the whole economy, basically.
Exactly. And then the other thing I just want to really clarify, because this is an unfortunate definitional issue we've been encountering lately.
Hmm.
Asset owners are universal owners. Asset managers are not universal owners. They are not owners.
Hmm.
Univer Asset managers have documented conflicts of interest when it comes to voting. They have totally different incentives. They are not universal owners. So I
Hmm.
just want to make that really, really clear. If my voice has a hint of irritation in it in clarifying the definition, it's because there's been confusion in this space, and it's much more useful as a concept to identify specifically asset owners as having this kind of interest and incentive because that falls apart really quickly if you start to look at their managers.
Yeah, it's a great point. And again, just for folks who might be not be familiar with the terminology, asset owners are typically groups like large pension funds, endowments, foundations, sovereign wealth funds. Like they're the groups at the end of the day that hold this capital and then they allocate it to managers who then in turn make investment decisions in companies or whatever asset class they're investing in. But yeah, so it's that asset owner who's really the owner, hence the name at the end of the day. That's the universal owner. And then talk a little bit about, so I think we're sort of alluding to it in this conversation, but the Anthropocene, what that means and how that relates to some of these topics around universal ownership.
Yeah, and I should just start by saying that I've had two major corrections to the my use of that term since I wrote that paper that I think
Okay.
are kind of cool.
Hmm.
One is that there's actual dispute around whether we are in the Anthropocene, and what the Anthropocene means is like a geological era that is can be kind of defined as being separate from other geological eras, and so basically what you're doing has to be able to show up in the sediment and so on.
Right.
And that is actually in dispute. But what it's meant to convey is the idea that humans have changed our biophysical world. And that's what people tend to mean when they're talking about the Anthropocene. But the other correction that I've had that's really helpful is that it's not like all humans have caused this problem. It's actually mainly wealthy people in wealthy countries. So it's actually not a responsibility on behalf of humanity as a whole. It really is highly skewed, and it's really interesting because top 10% of the population is reportedly responsible for over half of emissions, and I think sometimes the solutions that we propose presume that these emissions are a little bit more evenly distributed across the whole population, when in fact it is a relatively modest group of people who are responsible for a lot more of it than for example, the bottom 50% is responsible for something like 15% of global emissions. And so it really tells you where to focus.
Yeah, it's a great point on sort of the large scale equity components of all of this. But and yeah, good point on the sort of academic definitions, which are certainly important, especially to a lot of our academic listeners. But yeah, I think the idea is such that whether we're technically in the Anthropocene or not, it's the idea that the activities we are undertaking, and I think carbon emissions and climate change are probably one of the bigger examples of it, but also deforestation and other like large scale changes that our activities are driving to the Earth system is potentially driving us into this whole new sort of uh, epoch or era in terms of geological history, which is a pretty big idea if you think about it. And so in the paper, you also talk about how this sort of relates, these types of risks are existential risks. And so maybe talk a little bit about what that means and how that maybe compares to other more traditional investment risks that investors might think about.
Yeah, thank you. These are great questions. These don't normally come up in podcast questions, so I love it. And I'm sorry to do the nerdy academic thing, which is to also then get back into definitions here, because of course there are global catastrophic risks. So those are those that are enormous and probably interconnected with others, but that don't rise to the level of extinction risk. And then there are those that could plausibly eradicate all human life on Earth. And climate change is again one of those debated ones. It's not entirely clear. People are not. I mean, there could be a small band of humans who survive, post collapse or whatever. There are lots of discussions about potential huge futures hundreds of years from now, and it's highly debated. But I think sometimes using these words that sound quite severe can be kind of useful to help really focus our attention on just how bad it is, how essential it is that we act in this window that we have now, and it also helpfully extends the time frame over which we're thinking about these things. Sadly, I actually think people are misunderstanding climate change as a more long-term risk than it in fact is. If things don't change, I don't expect to enjoy a good retirement,
Hmm.
just to put it that way. It is anyone who is under the age of 65 from an actuarial perspective, if things don't change, is likely to see some really terrible things happen in their lifetimes.
Hmm.
So this is not as long-term a risk as we might hope. But I think looking at these risks that are so very big and interconnected is helpful, because one of the things that we I think fail to do in our thinking from the perspective of investment professionals is to take into account when things go really, really wrong. So the kind of the long tail, and people talk about that in probabilistic terms, and they talk about the fat tail. So like things that are really, really severe as risks can be more likely than we're assuming. And I think that climate change falls into that category. Whether you technically can call it an existential risk or whether it can be categorized as a catastrophic risk, it is probably more likely that those severe outcomes will happen than we're taking into account now. And the reason I say this is that if you look at the projections that have been made by scientists thus far, the actual outcomes are almost always on the worst end
Hmm.
of what they had predicted, or worse
Right.
than predicted, even within the range. So
Or coming sooner, or yeah.
yeah, exactly. And that's why we've downgraded the temperature goal. So it's not that we decided that we were going to become more ambitious and that's why we got to 1.5 degrees. It's because the things that we were worried about happening, we thought were going to happen at 3 degrees, then we thought they were going to happen at 2 degrees, and now it's pretty clear that some of them are actually happening now.
Right.
So yeah.
Yeah. Yeah. It's true. And I think that's a common one, and people sort of forget how conservative scientists really are in a lot of this research,
Mhm.
and they don't want to be accused of being alarmist or over the top. And so a lot of those aggregate results are actually a lot rosier than reality might be, and they're certainly not that rosy. So it's yeah, it's scary stuff, obviously for humans, but also kind of back to the topic of investors. It's real material risk sort of at the highest level in terms of particularly for universal owners, the impacts that this could have. And so, talk a little bit about what investors, institutional investors, endowments, and others can or should do, because as you mentioned, you can't really stock pick your way around it, because this stuff impacts the whole economy and they're universal owners. So, what does it look like in practice, and what are some examples of things investors can or should be doing to sort of help address these risks?
Another great question. So this is climate change is being called an unhedgeable or non-diversifiable risk. So yeah, you can't stock pick away from it, especially over any kind of longer term time horizon. So you actually have to try to have an impact on these risks in the real world. And my thinking has shifted on this a bit in the last few years, just having conducted a lot of research, but also just talking to people and understanding how things work in the real world. And I'm starting to understand that, in fact, part of what needs to happen is kind of a social discourse shift. So there are legitimate actors in society whose warnings are taken more seriously than others. And if the world's biggest pension funds, who are basically at the top of the food chain when it comes to the financial system, not only are they at the top of the food chain, though, they have the right incentives. They actually want to be able to pay out their beneficiaries in 30 years or 40 years. So they're kind of the right actors to say some of the things that need to be said. And if they say we can't pay out these pensions in 30 or 40 years without action on the part of governments and investors, then that's more likely to be taken seriously and to be in turn reflected in the kind of legislation and policy more generally that we need. So that's a big piece. And part of the thinking there is that actually stigma is more powerful than esteem. Like humans are more afraid of shaming than they are seekers of praise, you could say. So it we don't tend to legislate things either until they're viewed as sufficiently bad. So actually the act of divesting from fossil fuels, the goal there is actually to stigmatize that industry such that it can get to the point at which it is legislated appropriately. And I mean, right now we're still subsidizing fossil fuels. So the point of that whole movement is a social discourse one, and it's one I've become much more persuaded by, having started out, frankly, as a skeptic of that kind of tactic. So I now kind of start with the social discourse piece because I think that the legislation that's required is much more likely to happen if we get that kind of legitimate actor making that point in a way that can't be ignored. But then there are a bunch of other practical things that asset owners can do that tend to be lower cost than some of the ESG type approaches that you could take. So things like denying debt to any company that's engaging in fossil fuel expansion, voting against the reelection of directors. Those are my two favorite tactics as an investor because they are both they're strong indications that both are more likely to produce a response on the part of the company. And they're both quite low cost. So you have to vote for or against directors anyway. So it's kind of the same cost, whether you support or oppose a director. And then on the debt side, it's easier to replace something that you take out on the debt side and that has the same characteristics. So you can much more easily replicate the performance of the market as a whole while taking out exposures to any of those companies that are engaging in fossil fuel expansion, for example. So it's less likely to result in any kind of investment losses than it would be if you made those very same exclusions on the public equity side. And just to say, the vast majority of new capital flowing into fossil fuel expansion actually comes from debt, not equities. So this whole stock picking exercise tends to cost more, tends to cause you to deviate more from the benchmark, and is less likely to have what's called additionality or impact on the companies. So
Hmm.
to me, it's pretty clear we should be picking these much more likely to be impactful tools that also happen to be more likely to have low or zero cost.
Yeah, yeah. So on the debt side, it can more directly impact the cost of capital to these firms, whereas whoever buys or sells the stock doesn't really impact, the access to capital that they have because they've already gotten that capital through their stock offerings or when they issue debt.
Well said.
Yeah. Great. And so, yeah, well, I'm curious on that, and we didn't really talk about talking about this, but I know you've been doing some work on a bond index that really looks at this too. Is that something you want to talk about a little bit for folks?
I always love talking about the bond index because I can't believe it got over the line.
Hmm.
Um, we spent a couple of years basically investigating whether it would be possible to build a bond index. And just for anyone who isn't aware of what an index is, it is basically just a little slice of the whole universe, so to speak. So it's a way of kind of automatically investing in everything that's available on the bond side in this case. Um, and our design is based on, again, avoiding providing new capital to companies that are engaging in fossil fuel expansion. So the fossil fuel companies themselves, but frankly, especially because of any pipelines or LNG terminals or whatever else they're building, that infrastructure piece is really big for us. And then the utilities sector, that building hundreds of new gas-fired power plants in wealthy countries alone right now,
Hmm.
as well as woody biomass plants, and so on and so forth. And again, that's that lock-in risk. We don't tend to take into account the implications of building infrastructure that, I mean, there are power plants now running for well over 70 years.
Hmm.
That is a risk. Every time you build one, you could lock in emissions for that long. And just to briefly diverge into or to divert into a conversation about gas. I mean, gas is a fossil fuel. It is, people refer to it as natural gas. Sometimes they don't realize it's a fossil fuel, and the leakage rates can put gas above coal in terms of emissions. So it depends
Hmm.
on the leakage rate. But methane is a very potent gas, and that's what that's mainly what gas is.
Hmm.
It's methane. So it's something that we attend to very carefully with the bond index, and then we actually also take out the top banks and insurers financing or facilitating companies that are engaging in fossil fuel expansion, and then heavily underweighting the next tranche, and then overweighting the banks and insurers that are out of those activities entirely. So that's another element that doesn't tend to come into these kinds of products. And then I suppose the last unique element is that there is a kind of pathway to forgiveness. So if you halt any fossil fuel expansion activities and are phasing out according to a sensible climate scenario, you can come back into the index. So it's
Hmm.
quite exciting in that sense. It's not, you're forever out because your business classification is that of a fossil fuel company. We're actually saying this is your pathway, and your cost of capital can come down if you, make these changes in the real
Yeah.
world.
Got it. And just out of curiosity, how does that work? How's that operationalized? Like the index people, companies, investment managers can create products based on the index that then investors can buy.
Absolutely. They could also just use it as their reference benchmark. I mean,
Hmm.
that's the interesting thing about indices. They can be used in a number of ways. But yeah, there will be at least a couple of funds built off of the index right away, including for the university itself. The index
Nice.
is actually named after the university,
Hmm.
which is highly unusual.
Hmm.
So we'll be a keystone investor.
Very cool. Well, that's great. Great leadership again by Cambridge. And let's bring it back to the endowment a bit, because yeah, how are you seeing endowments and Cambridge or just others more generally thinking about this kind of whole concept of universal ownership and systemic risk? And obviously, all endowments or most endowments around the world have gotten pressure from students and faculty and other stakeholders to either divest or address climate in some ways. So yeah, just talk a little bit about like the unique role that higher ed endowments play in all of this.
It's really interesting. God, I'm just getting really into definitions in this conversation for some reason, and I just want
That's
to
good.
apologize for that. Because and I've actually just finished writing a paper that looks at this because technically the endowment model, sometimes referred to as the Yale model, is probably the least universal ownership-y version of an asset owner there is.
Hmm.
Because it's much less diversified than is typical for asset owners as a group. So typically, and you know this better than the vast majority of people, but it's a relatively small number of large uh, university endowments in the world. You have to be kind of at least over a billion to have that model. And what it involves is basically choosing boutique asset managers who are highly concentrated in a relatively small number of companies, of holdings. So you end up having a lot less diversification than the average endowment or pension fund or almost any other kind of asset owner. And so I would still define these endowments as universal owners because I think that they are diversified enough that they can't avoid these systemic risks. But others would reasonably disagree with me on this. But I think the other thing is that, and I think this is what you're hinting at with your question, these are institutions that have to have an eye to the future. And they have that combination of the future orientation because of students, but also the knowledge of the detail behind these risks and their implications. That means that there are no better actors to take a stand in this space. They have a lot of legitimacy as well. And again, if you're looking at social discourse impact, universities probably have more legitimacy than the vast majority of other types of institutions, and therefore kind of have a role to play that's pretty special and distinct in that sense. Um, my boss, the CFO, says Cambridge is an impact institution. You know, like that's what
Hmm.
universities, they're all about having an impact. So that's why we're kind of uniquely positioned and why we should be taking that really seriously and doing things that others might find it more difficult to do. We have a little bit more flexibility often, and there's a willingness to be creative and bold sometimes that isn't as easy for the trustees of a pension fund to sign up to.
Hmm. Yeah, it's a great point. And the longer I work with the sector, just the more important I realize it is, on all of those factors. And yeah, like you said, this the sort of social capital that they bring in addition to the financial capital to these conversations is really important. And not to digress, but that's why another reason why it's so sad to see them under attack here in the U.S. right now. But they have an important role to play in all this. So, and I'm also very conscious of your time. I know you have a very busy day or evening over there. So I want to just ask a few kind of quick rapid fire questions and then a couple of big picture questions that we always end with. So kind of the quick takes. What's one term or concept in finance that you wish more people understood?
Universal ownership, honestly, and we've already talked about that.
Hmm.
So I'll just kind of refer back to the beginning of the question. I just wish people understood that they're asset owners and they think very differently from asset managers and have way fewer conflicts of interest in particular. Um, Very distinct institutions.
Yeah, nice. And what about, we didn't talk too much about this, but the difference between ESG investing and some of the system level investing. Do you see that ESG investing as sort of a stepping stone to get investors thinking on the systemic level, or is it more of a harmful distraction that confuses things?
The latter. Um, it's like both because it's so useless and often more expensive. We're talking like stock picking, tilts and exclusions in public equity, labeling of funds as green when they really have uh, next to no impact, if any, and that can actually mislead people who think that it does have an impact because how could they conclude otherwise unless they had a lot of additional knowledge? So I think it can be quite misleading, and almost always using tools that are very unlikely to be effective. But I also think it kind of infects your brain and it doesn't allow you to have like it makes it harder to take on board the kind of universal ownership perspective because you are just thinking about investment as the ownership of stocks
Hmm.
and it actually I feel can impede understanding of that kind of more holistic perspective and understanding where new money, primary market capital actually comes from and the flows through the system. So I'm sort of anti-ESG, but not for the reasons we usually are.
Got it. Well, interesting. Okay, so how about an academic paper? I know you read a lot of them, other than your own, that has had a big impact on your thinking lately.
Ghoshal, 2005. Um, it's a fantastic paper about it's interesting because he's been kind of validated by some of the evidence that's come out since he wrote that paper. So this was published posthumously. This was Sumantra Ghoshal, who was at the London Business School.
Hmm.
And he wrote about how bad management theory can produce bad management practice. And it's basically about how the ways in which we teach students in business schools, and I would add economics because that's what my PhD was on, can actually get them to behave more selfishly, less cooperatively
Yeah. Hmm.
in the real world and under experimental conditions. And that really opened my eyes to the degree to which this could influence a lot of the ways in which we operate in the financial markets and also the real world.
Yeah, very. I'll have to check that out. That intuitively makes a ton of sense to me. Sounds like a good one. Okay, what about how optimistic are you about the ability of finance to solve the climate crisis?
I'm pretty pessimistic.
Hmm.
It's more I have faith in asset owners though.
Hmm.
I think that there is, and again, this is because of the research the qualitative research I've conducted with this group of people. Um, Typically, asset owners, the people who work for pension funds and university endowments could get paid more to do something else.
Right.
And so that they tend to be actually more pro-social. They tend to want to have a purpose in their work. And I think that the vast majority of them want to do something about climate change. And I think if we can facilitate that, there's some real potential to ring a big alarm bell that has not yet been rung
Hmm.
because we have a lot of incumbent actors in the financial system who have an interest in keeping things going as they are now. So I would say the answer isn't finance so much as the system change that's required could be facilitated by such powerful actors in the system taking a stand.
Yeah, I'd say investors and businesses more broadly, for better or worse, are very influential, right? So if we need that
Mhm.
policy, they're going to have a role to play, most likely. All right, how about on a personal note, when you're not writing papers and advising the endowment, what might we find you doing in Cambridge or elsewhere?
Hiking.
All right, nice,
Yeah.
beautiful place to do that.
Yeah.
And then how about a book, podcast, article, some kind of resource that students or listeners might appreciate?
I would recommend the Lukomnik and Hawley book on
Beyond
beyond.
modern. Hmm.
Yeah, but beyond modern portfolio theory, investing that matters, or something like that. But it's a slim volume that covers a lot of what you and I just talked about now, and it's the sort of it's become something that a lot of people read in this space, and it's because it's very good and very
Yeah,
useful.
that's a great one. We'll actually have John Lekomnik speaking at our next event in June, which I think this will probably come out after. But he does great work, and that's a great book. All right, so our final two questions we ask everyone. Given all this and all of your work, what is your vision for the future of finance? If we're to get this right and address these big existential risks, what is finance going to look like?
I I think and hope, I suppose, that it manages to put the thumb on the scale of the asset owners more so than incumbent interests that tend to distort the policy environment in which we operate. Like I think that in a way is some of the biggest impact that the financial system ends up having on the real world. Some of these very, very large companies and asset managers as well end up having a very serious impact on both directly on policymakers through trade associations and directly, but actually a lot of those trade associations end up distorting the information environment by spending quite a lot of money, in fact, more money on this than any direct lobbying, on promotions advertising, grant making, including to academics, who are more likely to find in their favor. So it's that distortion of the policy making and information environments that I think is particularly problematic, and I think that that's something that could be addressed in part with the help of asset owners. They have actually quite a lot of power cross jurisdictionally to decrease the influence of these kind of oligopolistic industries on the kind of legislation and regulation that we need. So I feel like that's one of the big shifts that again, I don't know whether to hope, but certainly I think that would make a big difference, and I'm going to choose to hope that that will happen.
Yeah, I love it. Well, obviously, we work with a network of asset owners and definitely feel the same way that if they're educated and sort of see this bigger picture, it's in their best, it's in everybody's best interest, obviously, but it can help get past some of those market distortions or perverse incentives that some groups or companies or industries face. That's kind of driving us down a path it's not going to help anybody. Okay, so finally, for students, young people, anyone interested in kind of a career in this space, any advice you would give them and sort of how to break in or prepare themselves to do so?
Be very careful. If you go into finance and you work for a bank or an asset management firm, it can influence your thinking in ways that you couldn't predict. And I don't tend to see people come through that with all of their values intact and with the kind of clear-eyed view of the system as a whole that I think is necessary to actually have an impact in this space. So, and I suppose I'm probably biased in saying that I haven't worked for those kinds of institutions. I worked for a credit union once for a summer, but that's about the closest that I've gotten. But it is, my PhD was on the influence of economics education on and business school education on people's thinking and behavior, and it's real. We have to be we're social mammals. We have to be careful about the kinds of environments in which we spend years and years and years, because it totally influences how we think and behave. So I know that's probably an unusual answer, but I would really approach things with a lot of caution.
That's a great answer and such a great point and great advice. So thank you. And Ellen, thank you again for your time on what I know is a busy day and for all the great work you're doing. It's been so good to catch up, and I hope we get to talk again soon.
Great to see you again, as always, and hope you come back to Cambridge for a visit sometime soon.
Yeah, me too. I miss it. All right, take care. Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.